Awesome. So thanks for saying, thanks for your patience as we get through those technical difficulties. This is an important topic because it's on everyone's mind, and that is how the election may impact the market and, more importantly, your portfolio. So we'll dive into some of the topics that we've been hearing lately, some of the questions, and then really the purpose of this is to give you the data, show you the data so that you can make an informed decision, and we can talk about what we're thinking in terms of the market so that you can be an informed investor. So with that being said, I'm going to start out with a quote that I love showing, right? And that is, the stock market is a device for transferring money from the inpatient to the patient. And now is no different of a time. It is just as relevant as it's ever been. And Warren Buffett always has some great choice words for us. And so what do we mean by that? So we're going to talk a little about 2016 and kind of some of the thoughts that were going on in the market at that time. Right? So leading up to the election in 2016, we saw a lot of media pandering for clicks, trying to get people to be scared. Markets were fearful of what a Trump economy would look like because it was going to be different. Whatever the change was going to be, it wouldn't be good. So in the beginning of October, we started to see a lot of bad articles come out to try and scare people. Even towards the end of October, right, people were saying that a Trump win would tank the markets, and this is not to be political about Trump or Democrat, Republican. This is to kind of just show you how the media kind of tries to scare people and what a lot of the thoughts are out there in the market. Again, then we'll show you the data behind what history tells us. Right. But ultimately, the markets are there to continue to be constant, even though the media wants to scare us. The media wants to sell advertisements. And the best way to sell advertisements has historically been to scare people and try to create controversy. So we've seen a lot of this recently. So looking back to the previous election, for the 2 months prior to the election, we saw a lot of market volatility. So here's an example of the S&P 500 and the NASDAQ. The S&P being in the red and the NASDAQ being in the blue, of what was happening prior to the election, right? There was a lot of fear. We didn't know what was going to happen. We had two candidates that hadn't been in office before. They were going to come in and drastically change the economy. What would that do? We saw a lot of volatility. And this is what we've been telling clients. Near term, around the election, we're going to see a lot of volatility because markets don't like uncertainty. That uncertainty lets the markets kind of go either directions, gives people a lot of opportunity to guess, to try and time the market. And ultimately what we see is it is based on a lot of news and a lot of information that people are predicting. And the problem with predicting is I don't have a crystal ball and neither does anybody else. So no one is very good at consistently getting that answer right. So we see the markets start to react pretty wildly as we get closer to the markets, as we get closer to the election. And this is no different than what we've seen this year. And if you remember, right, the media is going to be pandering. We're going to see lots of people on TV talking about crazy things and trying to create that fear and doubt in our own minds. And I'm going to play a clip for you here that goes back to the previous election from someone who I think's been an amazing business person and what they were saying in the 2016 election, what would happen. So I'll play that clip now.
And then there's the uncertainty of the election. I mean, I have my Trump hedge on. In the event Donald wins, I have no doubt in my mind the market tanks. And so I literally have put on a more than 100% hedge.
Really?
That I'll put on stronger if it looks like there's a better chance.
What does that mean? Donald Trump wins in November. What is Mark Cuban doing?
Mark Cuban, if the polls look like there's a decent chance that Donald could win, I'll put a huge hedge on that's over 100% of my equity positions and my bond position as well that protects me just in case he wins.
So there you have it. We've got a billionaire on TV back in 2016 talking about what he would do if it started to look like a change in presidency, right? If Donald Trump would get elected. Again, this isn't about which president's right. We're going to show you the data. We just want to talk about kind of the fear in the media and the things that are out there. So Mark Cuban said that he would put 100% hedge on both his equities and his fixed income position, which, by the way, you're not able to do. That's illegal. So if he had done that, he would have lost all his money. But that's kind of the thing that people are talking about, and we'll hear clients come in and say, kind of the opposite now is, oh, if Biden gets elected, I'm going to move out of America because I don't know what will happen, and it's so scary. We don't know what the uncertainty will be, but we like to caution people for making drastic emotional decisions, because what actually happened back in 2016 is that the S&P and the NASDAQ, again, the S&P in red, the NASDAQ in blue, have done pretty well, right? And again, that's despite a 2018 mini recession, got pretty close to a 20% drop in the fourth quarter of 2018. And again, that was kind of the Trump trying to trade wars. And we also had the Fed trying to aggressively raise the interest rate. The markets didn't respond correctly, I should say appropriately. And then we got into the coronavirus recession, which again, right, we'll go back and talk about this, but it doesn't matter if there's a Democrat or Republican in office. If something like the coronavirus happens, then the market's going to react negatively. And so we're watching things that do directly impact the market and do have correlation with market effect, not presidential elections, because our founding fathers, I don't know how they are able to do it, but they created a system so many years ago that does not allow one person to come in and drastically change the entire institution, right? There are so many different checks and balances in order that make it impossible for one person to come in and directly impact the market. So we watch things like the coronavirus and the stimulus package being put forward, because those things are going to have a much greater effect on your portfolio and on the market than does who gets elected. And we'll show you the data to support that. So even though the media is going to create all this hysterical news, trying to get people to click and sell advertisements, just know that the markets have gone up in the past. They did in 2016, and we'll look at data going all the way back to the early 1900s. Okay, so every year, right? And this is probably what someone's thinking, yeah, well, you know what? This time it's a little bit different. Well, every 4 years, this time's a little bit different. Everyone said that back in 2016. This time it's a little bit different. We're saying the exact same thing in 2020. Yeah, but this time feels a little bit different. It's always an emotional time around elections. It's always emotional. Now, as we've gotten further and further advanced, right, media now becomes so much more available, right? We used to just get it during the 6 o'clock hour, and maybe a little bit of stand up if you were able to stay up for Leno and Letterman or Carson, if you will. And so now we've got Twitter and we've got Instagram and we've got all this media that's available to us 24/7, 365, that we can just be stirred up so much more, and we can get into conversations with people across the globe and have kind of these emotional back and forth. So every year, it's actually not different, right? It's always a big change and it's always emotional, right? So what do the data show? If I'm saying, hey, this is not really different, and we've kind of looked back at what happened in 2016 with all the emotion and all the things that happened, what do the data show? Because ultimately, we want you to invest with evidence and kind of make sure that you don't make emotional and irrational decisions. So if we go back and look at the data, right, this is what you can go ahead and you can talk about the U.S. economy. You can look and see, right, and our investment philosophy is long-term, the market's always been positive. And through this time period, right, we're talking the early 1900s here, we've gone through a great depression. We've gone through the housing crisis. We've gone through World War II, Vietnam, countless pandemics. This market has always been positive over the long term, no matter how you slice and dice it. So you can see all the different changes in presidents and changes in Democrat or Republican. We have seen this before, and if you stay invested long term, you've always been rewarded. So I think it's very interesting just to kind of see the differences in Democrat versus Republican. This election seems so much more polarizing than the others, but the market is continuing to respond very rationally. So looking at some of the historical data, if we go back and look at how is the S&P index done by president based on the makeup of Congress, okay? So our blue box here is if we have a Democratic president, the red box if we have a Republican president, and then it looks at how the S&P did when we had a Democratic Senate, or I'm sorry, a Democratic Congress, a Republican Congress, or a split Congress. And then you can look at the Republican president with the Republican Congress, Democratic Congress, or a split Congress. So what we are not saying here is that Democratic president is always better, right? Some people may try to infer that, but that's not the case. What we're really saying is, one, I want you to take notice that no matter what the makeup of Congress, from 1950 to 2019, the market has always been positive long term. That's the key takeaway, right? All of those instances, the market has been positive. So that's a good thing for us. That's why we want to stay invested. What we've been finding is that the things that make a bigger impact in your portfolio is not who the president is or what the makeup of Congress is. It's actually what's happening in the market. And so some great examples of this recently, right, is 2020. It doesn't matter if Democrat or Republican are in office. It doesn't matter the makeup of Congress. If the coronavirus hits, the markets are going to take a bad turn. Okay, if we have to lock down the economy, we have to shut down businesses, then the markets are going to be impacted. Same would be true with 2001. It doesn't matter who's the president or who's in Congress. If two idiots decide to fly planes in the World Trade Center, the market's not going to respond positively. 2008, we have a housing crisis. We have the banks doing terrible things, right? Gambling with other people's money. We're going to have a huge impact to the market regardless of who's in office. And so the things that are good, the black swan events or the big market swingers are not going to be who makes up the presidency or who makes up Congress. It's going to be things that actually have a direct impact on the market. So we want to look at how does that, the difference in the party make up on market correlation, right? So what market correlation says is there a direct impact of having a Democratic president or a Republican president? Is there a strong relationship between the election outcome and the market returns? And so a 1-for-1 would be extremely strong market correlation. Something really near zero would mean there's very little evidence to show that being Democrat or Republican, the makeup of Congress makes a difference in the outcome of the market. And so what we see is the correlation between the type of party that's in office versus how the market performs is extremely low. Okay, it's almost negligible, right? It's almost zero to where it has no impact on the market. So if you can look at other things, right? Other ways we use market correlation, right? Would be like if we wanted to take a look at how does the US stock market correlate to the international stock market? Those things are much more highly correlated than who makes up the US presidency and who makes up Congress in the United States. So those are somewhere around 0.75-ish in terms of correlation, market correlation. They're much higher. So how the world economy works is going to make a much bigger difference in your overall portfolio than who wins office. So we say all of this to kind of calm some of the fear, right? The ultimate answer to all this, right, what the data is showing is it doesn't really matter who's in office. It doesn't really matter what the outcome is because there are so many other impacts to your portfolio that make a bigger difference. And hopefully you're seeing this, right? Now, if you turn on mainstream TV, you're not going to hear these things. If you turn on MSNBC or Fox Business News or whatever your flavor is, you're not going to hear these things, right? So what are some strategies that you can use and what are we doing for clients as we come through the market, right? So we'll take a look at a hypothetical investment of $10,000, right, through an election cycle. So this is looking at 22 different cycles since 1932. So if you stayed fully invested, you're going to get the best outcome. It was the best outcome to get invested and stay invested 14 out of the 22 cycles, right? Those are pretty good odds. What happens if you try and sit on the sidelines? Okay, I mean, pull all my money cash, let me see how the election goes. That worked out good. For years like the 70s where inflation was extremely high and money sitting in a savings account in a bank might have been getting you close to double digits or 7-8% sitting in savings account. Now we look at that recently, that's not going to be the same case. Inflation's been much lower. You're going to lose money sitting in a savings account. So sitting on the sidelines is probably a little bit overinflated in terms of best results. Also, it's going to take into account those years like 2001, right? When you get into terrorism activities and we have to shut down the economy to try and, come up with a war strategy, and people stop traveling for fear, all those things. Again, nothing to do with the election, things to do with outside impact of the market, which we have no idea if any of that will happen in 2021. So the best thing you can do is stay fully invested. All right. So what are some things that could change, right? Sean keeps saying the market is going to continue to be positive. We've seen this before. We've seen it for, close to 100 years. The market's always gone up long term. Don't make drastic changes. The media is there trying to scare you, right? The results tend to have been really, really good after an election. So what are some things that could change, right? Taxes. Now, I wasn't the best U.S. history major or student in the world, but I do remember that the executive branch, right, which is led by the president, does not make tax laws, right? That's done by the judicial branch. I'm sorry, the legislative branch. See, I told you it wasn't very good. By the legislative branch that creates tax laws. So we've got a proposal by a Biden administration and kind of what Trump is doing currently. We take a look at what things could change, right? Again, this is kind of looking at the worst case scenario. Again, one's a proposal because what we've seen, right, even with a president that we've had in the last 4 years, it's probably been as aggressive as could possibly be, the most dictator-like, if you will. He can't even just do whatever he wants, right? We got a system in place where things move slowly. There's a lot of different checks and balances. And so a president's not able to do them. So even if Biden does get elected, there's a very, very, very low chance that he's going to be able to come in and just change the tax law. However, one thing we know is certain is that tax laws do change. And so one thing that you can do is develop a plan, right? Make sure you've got a tax strategy in place. How will you mitigate taxes in getting up into and leading to retirement and then through retirement? How are you going to impact your estate plan? What changes are you going to make? Are there strategies that you can employ? Are there ways that you can do things like Roth conversions or backdoor Roth IRAs and come up with the best tax strategy based on today's current tax laws? Those are strategies that we highly recommend, right? So things that could change would be tax laws. We don't know what they will be. They won't be as drastic as whatever candidate's saying. That tends to be the result, but they could change. And so the best thing you can do is put together a good plan, make sure you're making course corrections and update that plan as tax laws change. Okay. So what can you do? Have a plan, make course corrections, and execute. What shouldn't you do and what do we not want you to do is just wing it, right? Panic based on all the fear that's happening, based on all the media that's out there, based on whatever message board you're on or the person in the cubicle sitting next to you, right? Don't go try and find the bottom of the internet, reading every message board, reading every blog, reading every article, because it's scary, right? And don't just hope it all works out. Those are things that you shouldn't do. When you have a plan, you make course corrections and you execute, then you have peace of mind with your finances. And that's ultimately what you should be trying to do. Know that we've seen this all before. The data is pretty overwhelming. All right, so what did the data show, right? What does the evidence show? You can't predict the market. You can't time it. The stock market will do what it's going to do around an election. We've seen it all before. No one can predict it. No matter how good the sales pitch is, no matter how good the product they want to sell you is, no one can predict the market. And the problem with trying to time the market is you got to be right twice. You got to get out at the right time and you got to get back in at the right time. And this is no more relevant than it's been in 2020. Our clients stayed invested during the coronavirus recession, and they've reaped the reward by staying invested through the bottom and the lows and coming back through the highs. And now that we're positive for the year in both the S&P, the NASDAQ's done great. U.S. Treasuries have done great. There are a lot of assets that have done really, really well in 2020, despite a coronavirus recession. Okay, so stay invested, right? We've seen that trying to time the market doesn't work. If you got out and you missed April, May, June, and then you're like, now it's time to get back in, you probably missed the majority of the run. Okay, don't try and time the market. You got to be right twice. No matter who becomes the president, you and I, we get another chance in 23 months by electing the entire House and a third of the Senate. So it doesn't really matter what happens, because if we don't like it, we get to change it in just a short couple of months. And the likelihood of a president coming in or the president staying in and making all sorts of drastic changes in 23 months is highly unlikely. We've seen it before. We've seen presidents of both parties with different makeups of Congress. The things that impact your market are not the president, is not the party that is running the show. It's going to be outside influences. Because no matter what happens, no matter what policies are created, superior companies have always grown by acting in shareholders' best interest. They've adapted, they've grown. We've had people come in and disrupt the market. And if it happens again, the US economy will continue to march on. It always has. So that's what the data recommend. All right. So what we recommend is invest with evidence. Do not invest with emotion. So how we help with that scenario is we don't promise returns. We know that past performance is not a guarantee of future results. We provide peace of mind by building portfolios based on evidence, not emotion, not trying to time the market, that are built for turbulent times like these, so that you can ride out our coronavirus recession, come out on the opposite end. You can get through an election cycle and come out of it on the appropriate end. We build portfolios tailored to how much risk you feel comfortable with. We do that through extremely low-cost exchange-traded funds. We don't charge commissions. We don't have transaction costs, because the best thing you can do is get market or slightly better than market returns, less cost. So the best thing you do is reduce your costs. And then we want to educate by meeting with clients regularly, having these webinars, making sure that you're informed, that you can block out the noise. You can block out the person, at the family Christmas party or Thanksgiving party that may or may not happen this year. You don't have to listen to them, because you can stay educated, informed, and know, hey, I've seen what the market's done in the past. We've been through election cycles. I'm going to stay invested. I'm in a portfolio that matches my comfort for risk. And ultimately what that does is it gives you peace of mind. That's the goal. So we develop that holistic strategy to meet your clients' needs, reduce taxes, and make course corrections where needed, because things will change. Tax laws will change. Policies will change. The market will continue to do what the market does. Your risk preference will change. And so we're there to give you that peace of mind so that you don't wing it. You're not a junk drawer investor. You don't just have statements coming in and you just hope that it all works out. You've got a plan and you're following it. That's how we help. So remember, right? If you mix politics with your investments, you're making a big mistake. Another Warren Buffett quote. So I'm going to open it up to questions and then kind of go back to a slide that kind of shows how stocks have done over a 4-year presidency. So if you have questions, please type them into the chat. But you can kind of just see, looking back on it, the S&P 500 index, going back to the early 1990s, how it's done over the last several elections. Right, we see the 2001, right, when we had the terrorist attacks. But other than that, the market's done pretty well after an election. Now realize that past performance is not a guarantee of future results. That's not what we're saying. But historically, after the election, the market has done pretty well, because markets like certainty. They kind of are able to adjust, kind of adapt to whatever the tax law or policies that they believe will be happening. And then companies can do the best thing that they possibly can, given the set of rules that they're given, and produce value for their shareholders. So